certified. And so we've been working tightly, very for a long time. On a more personal touch, so I would totally agree with Emmanuel. He was an extremely enthusiastic person, and always very supportive, and very generous. Uh, I would like, and maybe beyond also this modesty and many other qualities, I would say for me, one word that would describe him is radiance. I would say always, pretty much always in a very good humor, and again projecting always very positive vibes. I would like to give one anecdote about that shows the generosity he had. So when I moved to New York, when he hired me, so I was coming from France, and I had my wife had found a very nice apartment to rent, but we did not have the American bank account set up at that time. And actually, Peter Carr was my boss at the time, so did immediately agree to put a deposit of $20,000 to secure the apartment. So he was going much beyond what any normal boss would do, and that was quite typical of his really his good spirit, his goodwill. So we lost an incredible human being and a great scientist who had a very inquisitive mind, and he was very open and always looking at the possibilities instead of the limitations. So very often when he was discovering a new problem, so he was very excited, and even if when there were some setbacks, he was always able to reformulate it and to keep some positive statements out of it. So during the 6 years I had at Bloomberg in front of him, it was almost a ritual every morning that he was sharing with me basically the scientific thoughts of the night. So it was taking 1 or 2 hours every morning to discuss this. It was very enriching. So we all benefited from his warmth, and it's a very sad loss and a very untimely, and it it brings to all of us this reflection of the mortality that we are facing, and so let's try to enjoy every day because we know it can stop very suddenly. Thank you.
Thank you.
If it's okay, I just want to say just a couple of words because I got to leave in like 2 minutes. So if that's okay,
Sure.
Malind?
Absolutely. And thank you so much, Bruno. Appreciate your being able to join us today.
Yeah. Well, I'm a little different. I was the quant recruiter. That I worked very closely with Peter before he joined Morgan Stanley. The first time we met, we had a really nice lunch. This is over like 25 years ago. And and then when he was working at and a global head at Morgan Stanley, he tried to convince me to become an internal HR there, and I kindly told him that's not what I want to do. So I continued to work with him on the outside, and I just am just like he was such a humble, brilliant man, and he passed away before his time, and that's why I guess we have to, yeah, just like you said, Bruno, you just have to think of your own mentality and think of, like, to enjoy what we can in life. But I just get shocked, by something like this because he really was so young, and in my book, and so I just wanted to say that. Thank you.
Thank you for sharing, Robin.
Thank you.
Um, maybe Professor Tadroshan wants to jump in, or Armand.
Okay, I gotta go. Bye.
So much.
Hello,
Thank
Robin.
you.
Thank you for your
Bye.
very nice
Thanks.
comments.
Thank you.
Armand
Yeah,
can
Robin.
go. Armand can go. Bye, Robin.
Okay. Yeah, I just want to say a couple of things, a short, brief review that I remember the first time I had contacted Peter was when I was at Bankers Trust. We were doing some work on the bond models, and I was talking to Andrew Morton, the HJM model fellow, and then I had gotten in touch with Peter, and we had some conversations about the interest rate models and those things. And I remember when Andy came to run the fixed income research group over at Lehman Brothers in 1993. I think Peter had the desire to maybe perhaps go do a taste of what the street was like, because he had been in academia, since getting his PhD in 89. So I think I got him the first job on the street. He was a consultant for my group at the CRT Government Securities, which was a proprietary bond trading house in New York that now was merged with Nations Bank later on. So he had come down to do consulting on fixed income models, and just very humble fellow. It was extremely interesting. He had a good taste of trying to see how the models melded with the reality of the world. So he'd like to have some more a practitioner approach, which he lacked, of course, being at Cornell. He enjoyed having the contact with people who had sort of a more basic idea of how things work in terms of the rate structure and how that affects volatility. So we started at that point, and I think he got a really good taste of the street, which I think encouraged his move to the street full time. So I think I had the initial job offer that he took, and he always complained that the bank never paid him the consulting fee properly. He was always complaining about that the bank didn't remit the right amount. So for a long time, he always would rib me on that. And also, one other thing I was going to mention about a small thing about what Iman was saying about how Peter would always take time to explain stuff to people and go on a tangent. He had come out to our Leon and I have a place in Montauk, and the previous summer we had Peter as a guest out there for the weekend with his family. So he would go to a restaurant there in Montauk, and it was a waiter who was a finance student, was a waiter. So when he came by, I said, this fellow here is a very well-known swaps and volatility expert. You should talk to him. Maybe get you a job, when you finish school. So then I went to the bathroom, and I came back and I saw he was again on a piece of paper writing stuff out with his pen and paper, doing some volatility curves. And so he was so eager to help people out. It didn't matter that he was just somebody he just saw at a restaurant, and he had a very good. He didn't mind. He says, this fellow he's a student. I'm going to help him out. And he had that kind of a teacher mentality that here's somebody with a question, and I'm going to help him out. So I thought that was not many people would do that, but Peter had that ability. And then there's one last thing. It was about his ability to take a real life thing and work into it. If you remember that whole issue about these meme stocks a year ago, when you had those stocks had these big rallies when the retail people came in. So all these, I'm trying to explain what happened here. So the whole thing was due to, a lot of it was due to what's called the gamma shock, gamma squeeze, when you had people who had sold these out of the money options and not hedged them because they were so out of the money. And then retail people push the stock up, and the options go up in value, and the people who hedged are going to buy the stock. So the stock was rocketing up. So I told Peter about that. I said, maybe this could be interesting for your analysis, for for the smile, how to fix the smile, whatever. Maybe the calls become more expensive than the puts do. You know, the smile may shift. So he went back and he started doing all this analysis and all this work, and we started going back and forth. And so it wasn't really something which he was looking at, but he heard us, it was interesting, he said, let me look at this thing. So he really had the idea to sort of tackle anything which came up, which seemed to be like a real life thing. He didn't want to do all this. I think he liked doing the academic work, but he also liked to tackle some of the, you know, the current stuff that's going on and try to explain why things are happening. So when I brought things to him, either with the rates scenario, this gamma squeeze issue, he felt it was very, you know, I'm gonna look at this carefully and see what happens. So I really thought that was a fantastic way of looking at and taking his skill set and using it for, you know, practical applications. It was a big loss to the whole quant community. It's very tough. So that's my commentary. All right, Lev, you want to go, Leon?
Yeah, I have not much to add. I agree with what everybody said, Bruno, Emmanuel, Armand. Yeah, I mean, you know, wonderful mind, you know, seeking out inspiration from all places, you know, inspiring many, many people himself. I remember he gave a talk a couple of years ago at the Quant Boot Camp. That's run in the summer, and a lot of the entering Courant and Tandem students take the boot camp. And he gave this very interesting talk about kind of like looking at, I mean, some of this is familiar to people, but the way he presented it was very, very innovative. This idea about sort of thinking about option gamma effects in the context of the bond market. So, you know, the one step beyond the traditional notion of, you know, the price yield relationship being nonlinear. And a lot of interesting insights that he brought to the table from being an options person were brought to bear on, you know, this question. And of course, ultimately, you know, it's kind of a alternative way to think about, you know, relative value in the rate structure, sort of stuff like that. And it's wonderful the way he presented it to this group of people who were not necessarily options people at all, and didn't even necessarily have that much, you know, modeling kind of like, you know, engagement in their regular jobs among the people who were taking this course as, you know, professionals, not the entering students. So, but I could probably name many situations like that where he sort of, you know, took a subject and sort of, you know, sort of like, as Armand said, he brought his immense skill set to the table, but at the same time, he was willing to learn from people who saw the problem from different perspectives and kind of like, you know, amalgamate all those ideas together. So I loved him as a friend, as a colleague, and it's a tremendous loss for me and for our entire community.
Absolutely. Couldn't agree more. Welcome anybody else who wants to jump in and share their memories.
I'll say a few words. So as I mentioned, I'd met Peter when he came and joined Morgan Stanley. I had heard him speak before, but I hadn't known him personally. And Peter, you know, immediately, within a few days of meeting him, I remember he showed me, I had just received an email from Merton, one of the, you know, one of the winners of the Nobel Prize for Black-Scholes Merton, explaining exactly who did what in the Black-Scholes work. And, you know, back then at MIT, in those early days in the early 70s, late 60s and early 70s. And soon after that, at Morgan Stanley, I was working with Peter on figuring out compensation for the quant teams that worked below me and below Peter. And we were in a meeting with human resources. And all of a sudden, Peter says to the human resources person we were working with, "Oh, it's just tensor analysis," as if the human resources person would understand what that meant. So it was, I feel the way I would like to say it, it was difficult to separate the man from the mathematics. He was all math all the time. But I do think he went beyond that in the amount that he helped individuals. He really, I feel, brought together many people in the quant finance community. He was a, what do you call it, an influencer? There was a term that Malcolm Gladwell used to use about people who are sort of high connectivity nodes in kind of social network. Really brought a lot of people together, helped a lot of people, including myself, including many people who worked for me in their careers. And most recently, when I left my last job in October, I wanted to work more closely with Peter, and he and I started having seminars once a week and met a lot. And I came up with some results, and he said, "Oh, I had worked with him in industry. I'd never published papers with him before." He said, "That could be our first paper together." And we worked on it. In fact, I had spoken to him a few days before his last day of consciousness, and we exchanged an email on his last day of consciousness. He was his usual enthusiastic self. He planned a meeting to hear about my latest results that he was very excited about. Unfortunately, that was not to come to be. So I will now make sure to push through that work and publish it with his name on it. Yeah, that's all I have.
Well, thank you, Kevin. Anyone else?
Yeah, hi, can I say a word? Yeah,
Of course.
yeah, Bruno.
Uh,
Yeah,
Maybe you can, I may have missed your intro, Bruno. Maybe you can just introduce yourself or.
yeah, sure. Thank you, Millie. Yeah, my name is Bruno. I'm with NYU Tandem. I'm a part-time faculty. I was hired by Professor Carr to teach the first ESG course, Sustainable Finance. And he has passed a paper that I'm working on with another co-author here in Maryland. I would say that he was the balance between high intelligence and deep humility and profound wisdom, a perfect balance. It's a tremendous loss. He really launched my career as an academic, so I will forever remember him. Yeah.
Well, thank you so much for sharing that, Bruno. Can everybody hear me? I feel like my connection is the problem here.
Milan, by the way, you seem to have there are two different connections of Zoom that I see on the grid. Do you happen to see that?
I have the phone as a backup because, as you know,
I see. Okay, just letting you know. Thank you.
Crashed, but
Actually, there was one other thing I meant to mention. What Emmanuel Derman mentioned about the stop loss start gain. Peter had described that work to me. So one of the ways I like to describe Peter is like Richard Feynman. He felt that if you can't explain something simply, you don't understand it. And he had explained that to me. He had explained, so I'm actually, Peter had helped me get onto the board of the National Museum of Mathematics with him. And we're going to give an annual memorial lecture for Peter. And that was I'm going to give the first one. And I think I'm going to speak about stop loss, start gain, which I think could work as a public lecture of sort of a very intuitive way of describing option pricing and why options are different than just, say, limit orders or something like that.
Have a look at Mark Königsberg's, not Mark Königsberg, excuse me, he's there, Mark Rubenstein.
I will, I'll take a look, thank you.
It's FHJ, I can email it to you if you like. It's also a very beautiful paper.
That would be perfect. If you can remember how to spell my name, my email address is kevin@addison.com.
Okay.
It's interesting you mentioned the stop loss start gain paper, because I believe there was some sort of a Saturday seminar at Columbia, and probably in 20 years ago, and so definitely quite a while back, that I heard him first.
I think actually that was actually, I think that stop loss concept was actually in Hull's book in '89 when he first came out with that, with the book. That was one of the initial sort of intuitive hedging modes that he had talked about. So that was back, back in '89, which is interesting. So I think maybe it came from that.
Yeah, Rubenstein is
Peter's
88.
work, right? Perhaps.
Yeah, I dug it up somewhere. It's funny, it was in the FHJ and it's written under a pseudonym, but you can tell it's sort of tongue-in-cheek.
Right.
Interesting. And any other stories that people want to share?
So are people going to the church service on Saturday?
I will be there.
Right, the service is Saturday afternoon, right?
Actually, no, Saturday at 11 a.m.
All right.
Yeah, it's also going to be Zoomed in case people won't be able to make it, want to attend. I could send email me. I could send you the Zoom link for the memorial.
Thank you. That would be very kind because I'm still here stuck in Florida for now.
Sure.
This week. That would be awesome. Yeah, I just wanted to share a couple of my own stories. I mean, I ran into Peter at the first big derivatives conference I ever went to, which was in the fall of '96, and he was so friendly and welcoming. I thought everybody in the industry must be like him. But I was very surprised because for somebody who'd been on the Cornell faculty and was now at Morgan Stanley, he was very approachable and very welcoming, and got to know him. He immediately invited me to his class at Courant, and I remember sitting up in probably sometime in '97, might have been the fall of '97, and he was talking about this Canadian options idea and the stochastic tenor and things like that, and that was so creative and interesting to me to hear all of those things from him. But on from a personal angle, I'm very indebted to him because while he's inspired so many people, I mean, at least for me personally, I thought that he was very kind in helping me get published and get networked in that direction. And in particular, to just bring it back to the Quafa New context, when we relaunched what used to be the New York chapter of Quafa FIU, things were not going so well for the old organization, and we decided to rebrand it and kind of relaunch it and clean things up a bit. And I have to say that we're happy with the outcome. I hope you agree with that. But Peter was very kind in agreeing to be the speaker for that holiday party, which, the picture we'd circulated, which is on our website. And, Emmanuel was there, Nassim Taleb was there. It was a fantastic event. And our sort of holiday party with his speech on Samuelson and options pricing. And then we had him again later last year. I forget, maybe August of last year, he spoke again about Kelly. We took him out to dinner just around the corner at Tecombe, right next to Francis Tavern. So that's why I'm still sort of in a state of shock. It's just hard to believe that he's not there anymore. Just feels like yesterday we had that dinner. So anyway, and anyone else? Michael, did we hear from you?
Thank you for asking me. Yeah, I have a lot of memories of Peter. He worked for me for several years, and we would travel a lot to various universities. And what I always loved best was when he would give me the layman's version of stochastic local vol and teach me with his enthusiasm complex mathematics for the non-complex mathematician. So I really treasure those times and really enjoyed working with him on that, and I'll miss him deeply.
Thank you. By the way, I may have missed your intro. Where are you these days, Michael?
I'm at RBC Capital Markets. I run the quants team there, and I've hired a lot of people from the Tandon program.
Oh, fantastic. I used to be at RBC till 2009 in GAPS, running one of the prop desks.
Right on.
Fantastic. So, and anyone else before we can wrap up soon on this and take a 5-minute break to refill our drinks, then we can move on with Jason. But I just want to make sure everybody gets a chance to share their memories.
I'll just take 30 seconds. I didn't know Peter terribly well. I knew him because we were both on the board of the SQA, Society of Quantitative Analysts. I just attended a few board meetings with him, so I honestly can't say I knew him very well. He did seem a very nice and very knowledgeable person. The other thing I will mention is that I believe that New York University and the SQA are going to put on a joint conference lasting a couple of days later in April in honor of Peter. So that's not absolutely finalized yet, but I'm pretty sure it's going to happen, but I will mention it. And maybe you'd like to look out for it, and I'm sure it'll be very interesting.
Yes, Jason, this is Leon. There is going to be a David Shimko, who's one of the professors in Peter's department, is organizing a tandem event in June.
Okay.
In fact, the email came out, I think just maybe today. I think it came from the dean's office, actually, the tandem dean's office, about a conference in his honor over 2 days. I think it's the second week in June, I believe.
Oh, it's in June. Okay.
Yes, exactly right. And I'd be happy to circulate that as well. David Shimko is organizing that with the dean's office.
Good show.
Yeah, David is traveling, or else he would have been here today, but he's out of town this week.
Okay.
Okay, excellent. And Bruno mentioned that Bloomberg has an event on March 23rd. Is that next Wednesday, I guess?
Next Wednesday, that's correct. Next Wednesday, right.
Okay. Well, why don't we take a 5-minute break then, if unless anybody else has something to add, why don't we take a couple minutes to refill, and we'll come back with Jason's talk on we'll introduce him formally after the break. So let's regroup. Thank you.
Well,
That was very nice what you said about Peter. It was very nice.
yeah, actually, I'm texting with Michael Sternberg now. He's going to the talk on he's going to the services Saturday. Yeah. Yeah, put your audio mute. Yeah. No, but it's because it's coming over here though. Yeah.
Hey, Leon.
Milan, hi.
Are you at home or at the office?
I'm home. I'm home. Yeah, this is a spring break week at NYU.
Yeah, I'm actually sitting in the spring break capital, so I noticed that
That's right.
and the population of Fort Lauderdale has suddenly multiplied.
like the 1960s movie, right? The famous movie, Where the Boys Are. That takes place in Fort Lauderdale, I believe.
Yeah.
You know, that's the setting of it. Yeah.
Yeah, I don't think it's as crazy as things used to be during the MTV 90s, you know. I see that our colleague Gotham Wai has joined, and Krishna as well. Some of the people who help us out, and Gotham's been there from the beginning as webmaster. Can you hear us, Gotham? Krishna, how's your connection today?
He's on mute.
Gotham, can you hear us?
Hey, Milan, yeah, I can hear you.
Okay, good. Just welcoming you to the meeting.
Hi, Gautam. Hi, Krishna. It's Leon. Hello. How are you guys? Hi.
Professor, good to meet you.
Hi. Hi, Gautam.
Yeah, Krishna's in Miami as well, but it sounds like she messaged that her connection wasn't great. And my connection is pretty bad too, because sometimes, you know, with the video, my audio starts getting shaky. So, but I'll be back in New York in a week. I did want to mention that actually, folks, you know, next time in April, and I forget if it's April 19th, is it, or?
19th, I think 19th, that's correct, yes.
Yeah, April 19th is a Tuesday. I was trying to move it to a Wednesday, Leon, for you, but unfortunately, this is a live event, so we have to go with what the venue could accommodate, and they can't accommodate Wednesday without a steep fee. So we had to go with Tuesday, but we're going to do the speaker dinner on Wednesday. How's that?
Thank you. Yeah, thanks for accommodating me on that. I appreciate it.
Absolutely. We can't do the speaker dinner without you. And so on 19th of April, Tuesday, we're going to have my friend and classmate Tony Berkman of Two Sigma. I hope many of you will be able to make it to that event live. So please remember to go sign up online. The live events, unfortunately, are not free. We have to have some modest charge to accommodate sort of the operating expenses. And Gotham, remember to please update the website for that. I don't know if you have it. There might be a slight arbitrage before Gotham manages to update the website. So. In any case, yeah.
Just to mention, we have coming up later in the year, we have this is not 100% confirmed, but we have a speaker talking about the mortgage market, somebody speaking about model risk, somebody speaking about correlation-based correlation derivatives, and the fourth speaker is going to give, I think, just a general survey about innovations in market risks. And over the next, let's say, 4 to 6 months, we'll have these four speakers will appear, but the schedule isn't quite definitive yet.
Fantastic. Well, let's get them on the website soon so people can start signing up. We may have somebody who just wrote a book about Bill Gross approached me, so I have to remember to.
Oh, the book was reviewed last week in the Wall Street Journal.
That's right.
And so, did anybody read the great line from the review? Supposedly, there was somebody who worked at PIMCO was describing what it was like to interview at PIMCO, and one of the questions that you were asked, Milan, you read it right? It was like, were you abused as a child? Second question was, did you like it? That anecdote is told I guess that's told in the book, and the reviewer in the journal mentioned that story in his or her review of the book. I think it's called The Bond King, right, Milan? Is that right?
I think that's the book. You're right. Okay, exactly. So, well, we love book reviews, by the way. And I should just point this out to anybody in the room that, you know, if you have papers or book launches or anything you want to propose, you know, we're always open to new ideas. And Sometimes book launches are really exciting. I mean, when we did the book signing with Greg Zuckerman 2 years ago, that was fantastic. We had an amazing turnout, and just all the stories about Renaissance and Jim Simons. That was a fantastic event. So we always welcome those type of events too. If everybody's settled back in, then why don't we get started with our speaker for the evening, Jason MacQueen, on measuring and managing portfolio inefficiency. I hope I got that mouthful right. Well, I asked for Jason's bio, and I got a very succinct one-liner which says, he leaps over tall buildings in a single bound and dodges speeding bullets. So there you have it, Jason MacQueen. But no, on a more serious note, when he's not busy doing that, he runs the Smart Portfolio Strategies. I guess that's his latest venture. I mean, Jason, are you still affiliated with Northfield, or is this a separate company?
We're just good friends, as they say.
Okay. I mean, but you sold one of your previous shops to, I thought you were somehow affiliated.
I did indeed sell my last business to Northfield. I worked as their director of research for about 3 years. No, more than that, about 5 years. But then I left to concentrate on smart portfolio strategies.
Perfect. And looks like you had a couple of other ventures before that. I didn't realize that your first company, Quantec, went back to 78 or 80?
Correct. That's 1978, not 1878.
Well, that's still pretty amazing. If you had a risk model for the UK back in the 70s, that's pretty amazing. I was not old enough to know what a model was, let alone a risk model, but that's pretty amazing. So actually, before you start, I'd love to, if you have a few minutes, to just go over the history of risk models as you've seen it. I think that might be quite interesting too, since you've been around for a while doing this.
I'd be very happy to do that.
That's really phenomenal. And looks like in the 90s you were doing the early global risk models and so on, and then you had another outfit called R Squared Risk, and that's the one that you sold to Northfield. So
that's the one we sold to Northfield, yeah. So Quantec was my first business. We built the first risk models for all the developed markets and most of the emerging markets, obviously apart from the USA, which was done first of all by Bar Rosenberg at Barra. But we built the first models for all other markets. We also built the first global model. We also built the first global asset allocation product. I spent about 20 years doing Quantec. We ended up with clients all over the world. We eventually sold it to what is now Thomson Reuters. I think they changed their name again. And they had me on consulting retainer for 2 years after that, together with some of my colleagues. And I learned something about big organizations during that 2-year period. So within 2 years, we had 5 corporate reorganizations. And the way it worked was that when they first bought my company, I had my own office. And after the first reorganization, I had a shared office. And after the next reorganization, I had my own desk on an open plan area. And after the next reorganization, I was hot desking. And after the last reorganization, I used to just come in like every month or two and walk around and say hi to people that I knew and leave. I didn't even have a desk at that point. So that's my experience of large organizations.
Yeah. Well,
since it's slightly relevant, if I may then, let me just take a minute to tell you what happened then. So one of the things I did during those 2 years was to wonder why it was that it was so difficult to get portfolio managers to actually use the stuff that they were buying from us. We ended up with I think we had about 300 clients worldwide by the time we sold Quantec. And by the way, can I just shout out to my old sparring partner, Victor. Hi, Victor, how are you? Nice to see you here. Yeah, and I spent a lot of time wondering why it was that portfolio managers were so reluctant to actually use the models that we were selling them. And I persuaded myself that it was because every active manager on the planet thinks, rightly or wrongly, that they have their own unique, special, proprietary, wonderful way of thinking about stocks, picking stocks, putting them into groups, thinking about industries, thinking about country groupings, how they define styles, and so on and so forth. And so they all do that, and they pick their stocks and they build their portfolio. And then, like good little managers, they get some scruffy little quants to run it through a risk model, and they do their best to have a look at the outcome, the report, and make some sense of it. And so they might look at their total risk, they might look at their tracking error, they might tick the box to say that they're within whatever the mandate says they're supposed to be in. They might even look at the beta of their portfolio to their benchmark to see if that's within acceptable limits. But very rarely would they go any further. And I kept wondering why this was. And I eventually convinced myself it was because when you build risk models to sell to lots of different managers, which most people do, you want to make it as general and as broad and as encompassing as possible. And in doing that, you obviously make some choices. But now the trouble is that here's the manager, and let's just say the manager has decided that they like biotechnology and they don't like pharmaceuticals. And that's one of the things they built into their portfolio. So now they reach for their risk model, and it turns out their risk model has got a healthcare sector factor, and they have no way of disentangling the bet on biotechnology and the bet against pharmaceuticals. So I persuaded myself that the answer to this was to build custom risk models, to build models that exactly reflected somebody's investment process. And so when we started R Squared, that would be 2003, our goal was to build custom risk models so that people could see exactly the bets that they kind of already knew they were making, but now they could see them clearly, and even better, they could quantify them. They could see how big the bets were. So we did that. And when you build a custom risk model for somebody, it kind of goes through two tests. The first test is we all sit around a committee table and they tell us what they're doing, and we get some data and we go away and the programmers build the model. And the first thing that happens is they give me the model and I have a look at it to see if it looks like a sensible model. Have we done something silly? Is the correlation matrix symmetric? Do the factor volatilities look about right? Is the distribution of the betas for the various factors sensible, and so on and so forth? If it passes that test, then we go on to the really important test. The really important test is we go back to the client, we say, righto, we've got a prototype of your model. Give us your portfolio and your benchmark if appropriate, and let's put it through and let's see what it's telling us. And so we do this, and we'd all be sitting around looking at the results. And let's just say this was a manager who liked high value stocks and small cap stocks. And that was the main reason. That was the main way in which they were trying to outperform. High bet on value and a bet on small cap. And so we'll have built a model that defines value the way they define it, and that recognizes what's small cap and what's large cap and so on. And obviously it'll have a bunch of other factors in there as well. We'll be sitting there and say, oh, look, there's your high value bet. It's 17% of your risk. And look, there's your small cap bet. It's another 21% of your risk. And we were doing this, and we did this for many clients over the next 12 years. And unexpectedly, my partner and I began to develop a very strong Bayesian prior that the next time we did this for a client, we would discover that less than half of the risk they were taking were deliberate bets. I don't think there was ever a single case where the deliberate bets were actually more than 50% of the risk the managers were taking. And on the strength of that experience, I came up with, which I'm going to hear about in the talk in a minute, is my own explanation for why it is that active managers don't generally outperform their benchmarks. It's not because the markets are efficient, it's because their portfolios don't reflect their stock selection skill. There's far too much noise going on in there. And so what Smart Portfolio Strategies is trying to do is to build portfolios that do capture a manager's skill as accurately as possible and make sure that the performance does actually reflect that skill instead of being a long way different from it. Anyway, so we sold that to Northfield in 2014. As I say, I spent some time working at Northfield, mainly on the model that we'd already built for FactSet, for their multi-asset class product. But nowadays, I just focus on Smart Portfolio Strategies.
Well, it sounds like you're hinting at some very interesting issues. I think we discussed some of that with Doug Martin before last year when Doug was speaking about his approach. One of the very confusing things in the industry, Jason, I'm sure you've run into this talking to many of your clients, is a lot of people get confused between the multi-factor alpha, kind of the outgrowth of the Fama French, taming the factor zoo of the hundreds of factors that have cropped up since Size and Style, and bridging that sort of between, the Fama French world and maybe the Fama Macbeth world, if you're kind of risk factors, right? The Barra Northfield type of approach. Is that something you could comment on very briefly before we get started?
You shouldn't really say Barra and Northfield approach because they have two different approaches. Barra were the first people to build a risk model. I don't know if you know, but the two people who actually built the model, which are Bar Rosenberg and, oh my goodness, I've forgotten his name, Indian academic. Anyway, no, it wasn't Andrew. This was long before Andrew came along. It might come back to me. It begins with M and I can't remember it. I'm embarrassed to say. Never mind. They were both in operations research before they built the first ever risk model. And in operation research, they were also working on multi-factor models of various problems. But the kind of problems they were working on were the kind of problems where what you could observe were the equivalent of the betas, and what you had to estimate was the equivalent of the factors. And so when they decided to build the first US risk model, it seemed to them to just simply use the technique that they were familiar with, which is basically a cross-sectional model. You give yourself the betas to all the factors of all the stocks in the universe to all the factors, and you run cross-sectional regressions to estimate the factor returns period by period. If you're using, let's just say, 5 years of monthly returns, you would do that 60 times, once for each month. You would then chain link the factor returns, estimated factor returns together, and then you'd have your factor volatilities and, of course, your factor covariance matrix. Meanwhile, you've already given yourself the betas, and somewhere along the way, you've also got out some residuals. So you've now got the stock residual risks, and now you're done, you've built your model, okay? So that is one way of doing it. When Axioma came along, they bought the code that Goldman Sachs had originally built to front run Barra clients. A very entertaining story, I'm sure you know that. But that was also built the same way. It was a cross-sectional model. Now, one of the problems, of course, with a cross-sectional model is that every time you update the model, you have to give yourself betas of all the stocks to all the factors. And if you've got, 10,000 stocks and 50 factors, you're talking about giving yourself 500,000 betas every time you update the model. And how on earth do you do that? Well, the answer is, not to put too fine a point on it, they cheat. They give themselves dummy variables. So you take a stock, you say it's going to have a 1 on, let's just say we're doing a global model, and suppose the stock is Société Générale. We say, what do we know about Société Générale? Well, it's French, it's priced in euros, and it's a bank. So what we're going to do is we're going to give this thing a beta of 1 on France, 1 on presumably European banking, and 1 on the euro, if we're building a US dollar-based currency model. And now we've got the betas, and now we can go off and do our regressions, and everything's hunky-dory. Style betas, of course, are different. They might use various composites for value, quality, growth, momentum, and so on. But apart from those, all the betas are dummy variables. So that's how they do it. That's very easy to do. You only have to do it once. It hardly ever changes. The trouble is, it's simply not correct. Not all French stocks do actually have betas of 1 to the French market. Not all stocks priced in euros react the same way to changes in the euro-dollar exchange rate. And clearly not all bank stocks have the same beta to European banking. So the way that Northfield does it and the way that Quantec did it, and I believe I'm right in saying that Northfield got the idea from Quantec, is we do it the other way. We say, okay, let's give ourselves the factor returns and let's estimate the betas by doing time series regressions. So these are called time series approaches or cross-sectional approaches. The interesting thing about these two approaches is that in both cases, you're doing estimation. In both cases, you will have estimation error. In the case of the Barra Axioma cross-sectional approach, the estimation error is going to be in the factor returns and therefore in the factor covariance matrix. In the case of the time series approach, of course, the estimation error is going to be in the stock betas. And so then the interesting question is, so what? There's estimation error somewhere. Does it make a difference at the end of the day? Well, one of the things that I tell my students, some of whom I see sitting here, is that no one builds stock risk models because they care about stock risk. They only build them because they care about portfolio risk. So the test of a good risk model is not about what it does in terms of stock risk. It's in terms of how good it is at forecasting portfolio risk. And it turns out that those two methods have different consequences at the level of portfolio risk. As quickly as I can, I'll explain what that is. If you have done a cross-section, so the way to test this is, suppose you take a set of stocks, a set of data, a set of factors, and you build two models. You build a cross-sectional model and you build a time series model. So everything's all the same except the way in which you've estimated the model. Then you can do that, and you can build yourself some models, and you can construct some portfolios, and you can do a whole bunch of testing to see which model does a better job of forecasting portfolio risk. It turns out the answer is that the time series approach will always give a better forecast of portfolio risk than the cross-sectional model. And the reason is actually very simple. It's because when you're calculating portfolio risk, you obviously need to include the factor covariance matrix. And if there's estimation error in the factor covariance matrix, clearly that's going to affect your forecast of portfolio risk for a portfolio, just as it would for a stock. If, on the other hand, you're using a time series model, your estimation error is in the stock betas. And before those are used to calculate portfolio risk, you have to calculate portfolio betas. Very simple calculation. They're just weighted averages of the stock betas weighted by the holding sizes. So now we're going to make two assumptions. One assumption is that you have a, quote, reasonably well-diversified portfolio, which in practice means probably more than about 30 stocks, and without one of the stocks being 80% of the portfolio, so something like sensible like that. The second assumption I'm going to make is that the estimation errors in the different betas of the different stocks, the different factors, are not systematically correlated with each other. No reason I can think of why they should be, and I've never been able to find any evidence that they were. But given those two assumptions, if we have estimation error in stock betas, and if we now calculate portfolio betas as weighted averages of the individual stock betas weighted by the holding sizes, then what's going to happen is that some of the estimation errors in the stock betas are going to get diversified away. And curiously and slightly paradoxically, we're going to end up with better quality portfolio betas than the individual stock betas that we started with. I am not saying that we're going to diversify away all of the estimation error. All I'm saying is that some of it will get diversified away. And so then it turns out that when you estimate portfolio risk using a time series model, same factors, same data, same everything, except it's time series rather than cross-sectional, you do actually get better forecasts of portfolio risk than you do from the cross-sectional model. So that's why we do mostly time series models.
Jason, can I ask you, Jason,
Yes.
ask you a question? When you say that you never saw a client where more than 50% of the risk that you've discovered in their portfolio, they recognize, right? Is that because, let's say, they're...
I wouldn't say that they recognized, they just hadn't appreciated. They knew perfectly well what bets they were trying to make to outperform, okay? The example I gave, I said they were high value small cap managers, but lots of different, we did this for 20 or more different firms. And it's not that they didn't realize there was other stuff there, they just hadn't appreciated the magnitude and the effect it was having on performance.
But is that because let's say for your model, you had, let's say, an agnostic beta, but they sort of had a kind of a biased beta, or was there other reasons why that situation emerged?
These were custom models based on their data and their way of thinking about things. The whole point of the custom model is to reflect the investment process as accurately as possible. So,
but with these fundamental PMs who may not be aware of their accidental unintended bets or even quants.
So I will claim with very little modesty to be a pretty good quant, but I will equally well claim to be a terrible businessman. It turns out that the business model we had for R squared was possibly the worst business model ever invented. We were building custom models for one client at a time. The client was the only client that ever got to use the model, so there was no leverage in it. Turned out we also had a relatively limited market because only managers who had a fairly well-defined investment process could actually tell us enough about what they were doing for us to be able to build a model to reflect it. So all of our clients were sort of fairly quantity large firms.
I see.
But nonetheless, there was not one of them where more than 50% of the risk they were taking was actually deliberate bets.
Yeah.
You know, I can sort of see something like that happens actually in the fixed income world, in the mortgage market, where, you know, you have kind of like this very empirical, they call it, you know, I guess you would call it the empirical durations of mortgage bonds. And that may differ from kind of a pure model theoretic duration.
Yeah.
You know, or for instance, let's say another example is like, you know, you could have a agnostic model-based approach to risk, but it may not be granular enough to identify fundamentally what the person is trading.
Yeah.
So it's like they're going to say, well, you know, it's better off for me to do an empirical model and use actual data of the bet that I'm making than, let's say, a model theoretic thing, which is not refined enough to identify exactly what I'm doing. So I've encountered that actual situation more than once, actually.
Yeah, I would agree with that.
Yeah. Well, but I mean, even Risk Metrics had a time series approach, right? Going way back, as I recall, and I remember having some
very short term, I believe.
Yeah, I mean, that's right. They were using daily data and short terms, half and stuff, but it was meant to be more of a trading model because it came from the trading desk context. But I remember having this.
Till Guldiman, wasn't it?
Sorry.
Till Guldiman was the guy who invented it, I think.
That's right, and they had a whole bunch of people. Back then, Chris Finger, and I remember the original JP Morgan team, but there was one guy, Peter Zangari, who was involved in the PACE team. And because you mentioned Axioma, and actually, you know, Sebastian, who started Axioma, used to be on the Columbia faculty, but he was from my Carnegie Mellon, or rather, I was from the same Carnegie Mellon program as him. So I had the opportunity to collaborate with him in the late 90s, and he helped us and stuff, and we this is before he started Axioma, actually.
Right.
And in any case, so and later on they ended up acquiring Pace, right? When Goldman wanted to get rid of that unit, there was some interesting transaction that took place. In any case, that's
I thought Goldman swapped the code for a chunk of Axioma stock.
Right. I mean, however the transaction transpired, I should be careful in phrasing that. If you want to launch into your presentation, maybe
perhaps I should. Now that does assume that I'm technically competent enough to share the screen with you all. So let me see if I can do that. Oh, that's cool. What can you all see?
We can see your screen, I think, but wait, there's something in the middle. Oh,
can you see a large green PowerPoint slide saying measuring and managing portfolio inefficiency?
Yeah, we see it. I think maybe you can just hide the slides in the back. Yeah, go into the projection mode. Thank you.
There we go.
All right, perfect. So I'm going to mute myself, fade away. I don't know if we need to make you the presenter or this may suffice, I suppose.
Yeah, am I still okay? I'm going to guess I am.
Yeah. So let's.
All right, let me bash on with this. Do we want to keep questions to the end? We probably do. I don't mind myself. If anybody wants to interrupt halfway through, please do so. But it might be a bit tricky with this Zoom thing. But anyway, let me go through with this, and then we can have questions at the end. So this is about measuring and managing portfolio inefficiency. Let me explain where we're going. The main tenets of modern, by the way, let me just say one other thing. My colleagues sometimes tell me off for this. but I always write my presentations so that they can be read standalone afterwards and they still make sense. Sometimes people say, no, just put absolute sort of highlights on and there we go. But I like them to be standalone afterwards, so that's where they are. So there we go. All right, so modern portfolio theory clearly is well known to most of the people listening here today. You may or may not remember all of the sometimes very heroic assumptions that are made. And many aspects of MPT have passed into common fund manager knowledge and indeed into the CFA syllabus. And whether they realize it or not, they affect the behavior of many fund managers and some investors. What I'm going to focus on is some rather unfortunate consequences of some of these assumptions, particularly as they relate to portfolio efficiency and active management. In particular, we're going to talk about the efficient market hypothesis, to some extent about the capital asset pricing model, and most of all about whether or not the market portfolio itself is Markowitz efficient. One thing I do want to make absolutely clear is that the term efficient in efficient market hypothesis refers to something quite different from the term efficient in the phrase Markowitz efficient. There are two different definitions of efficiency. One is about the pricing of individual stocks. The other is about the construction of a portfolio. So academics are very fond of claiming that active managers are doomed to fail and that actively managed funds, since they incur transaction costs and charge management fees, must underperform. In my view, that is just simply not true. And today I hope to show you why. Let's just consider some of these assumptions and tenets in a bit more detail. For Markowitz efficient portfolios, we're supposed to be trading expected returns off evenly against risk, with some risk aversion parameter psi, which if we're rational will be positive, but beyond saying that it's positive, we have no particular values in mind. One of the big drawbacks of Markowitz is that it assumes that the expected returns and risks are known with certainty. In reality, of course, the expected returns are usually ranges, and even the best risk numbers in the world, which happen to be ours, are only estimates, and the world isn't stationary anyway. So there is no certainty in either expected returns or risks, more so perhaps in risks than returns, but nonetheless, there is none. Farmer's efficient market hypothesis would have us believe that all stocks are at least more or less fairly priced all the time, but it assumes that all information is available to all investors simultaneously and that they can all process that information rationally to come up with an agreed fair value. Even with the internet these days, it can't possibly be true that all investors get all information at the same time, and no one really believes that all investors are rational. It's easy to find examples of investors who are clearly not rational, for example. Problems with these unrealistic assumptions. Harry Markowitz got a Nobel Prize for his idea of trading off expected returns against risks to create efficient portfolios. I personally think the Nobel Prize was well deserved. I think it's an absolutely brilliant idea. What I'm going to explain in a few slides' time is that the problem is not with the idea, but the way in which the idea is being used, the way it's being implemented. The apparently innocent assumption that these values are known with certainty in practice renders Markowitz optimization almost unusable in practice. If any of you, and I'm sure you have tried using optimization, you will usually find that the only way to get acceptable answers out is to put on lots of constraints. I used to sit with clients in Quantec days when they're running optimizations, and it sometimes felt as if they ultimately were putting on enough constraints to get back the portfolio they wanted in the first place. In reality, expected returns represent ranges of likely outcomes. Risk numbers are estimates, and I would therefore argue that portfolio efficiency itself should really be a relative concept. As Rob Arnott has observed, in a capitalization weighted index, overpriced stocks will be overweight, underpriced stocks will be underweight. And unless markets really are perfectly efficient, that must be true. And if that is true, then a market portfolio, I should say a market capitalization weighted portfolio, cannot be efficient. It must be inefficient. So as I said, what I'm going to talk about mostly is the implementation of the idea of portfolio efficiency. And I'm going to show you how it can be used so that active managers can get the most best possible performance out of the skill that I believe most of them actually have. I appear to be going backwards, not forwards. So let me try and go forwards. There we go. So here's the case for the prosecution. This is the case that finance academics make. All active managers are trying to outperform the benchmark, but in aggregate, their excess returns must sum to zero. And that, of course, is before transaction costs and management fees. So clearly, many of them will underperform. And indeed, I go so far as to say, on average, they must underperform because of the transaction costs and the management fees. I will just point out that active managers aren't only competing with each other, and perhaps I should say professional active managers aren't only competing with each other, they're also competing with all of the other investors in the market. In some cases, clearly that includes retail investors, but equally it includes sometimes other players such as central banks who decide to get into equity markets for some reason. Academics are very fond of producing surveys of the underperformance of mutual funds and other actively managed portfolios, supporting evidence for their claim that active management is doomed to fail. They often find that a small proportion of the funds outperform in any particular year, but they usually find also that the ones that outperform one year tend not to do so in subsequent years. And so they say it's just luck, skill can't exist, end of discussion, QED. I would point out politely that this is circumstantial evidence. This is not proof beyond a reasonable doubt. As one of my friends said, this is not criminal law, this is civil law. So in civil law terminology, the case is not proven on the balance of probabilities. The fact that most managers, mutual funds, for example, do underperform most of the time is not itself proof that it can't be done. It's just circumstantial evidence. There is a reductio ad absurdum paradox here. For those of us who don't speak Latin fluently, that means reduced to an absurdity. It goes like this. Professional active managers spend most of their time and much of their resources on stock selection. They build models, they do research, they hire analysts, they visit companies, they go to trade shows, they do all kinds of stuff they can to try and identify which stocks are going to do well and which stocks are not going to do well, which stocks are going to do badly. And so, the academics would have us believe that all this effort is completely wasted. But of course, if all the active managers gave up trying to outperform and everybody became a passive investor, then there'd be much less price discovery going on and stock prices would very quickly become very inefficient. So for stock prices to be even fairly efficient, there must surely be a significant amount of stock selection research being done. Second point is that it's highly unlikely that all investors are equally good at this stock selection research. So it would then follow that some active managers would be better at it than others. So the paradox is that it seems that for even a mild form of the efficient market hypothesis to hold, first of all, there must be stock selection skill out there. And secondly, it must be true that some active managers are better at it than others. I don't think these are terribly contentious assertions. So I'd be curious if anybody wants to argue with that later on. But all I require is that some managers should have stock selection skill and some should be better at it than others. What about the case for the defense? So now the charge is, you say you're an active manager, you say you have skill at picking stocks, how come it doesn't show up in your portfolio performance? Well, portfolio performance comes from two things. It comes partly from stock selection skill. I would say that if you don't have any stock selection skill, then you're probably not going to outperform. It's a necessary but not sufficient condition. But the second thing it needs portfolio construction skill. You need to build a portfolio that makes the most of your stock selection skill, that actually reflects it in the performance. There is another talk that I did a year or so back called On the Value of Portfolio Construction, which I'd be happy to send anybody who has not already seen it, which tries to demonstrate that if you choose the same stocks the same way, rebalance the portfolios at the same frequency and so on, everything the same, but just vary the method of portfolio construction, you can in fact get wildly different performance at the end of the period. So if you're a skilled active manager, in the sense that you do have useful stock selection skill, you can still underperform your benchmark if your portfolios aren't designed to maximize the impact of your skill and minimize everything else, which I'm now going to call noise. And I already kind of just told you this story. For about 12 years, we built custom risk models for quant managers. And to our surprise and amazement, we discovered that in every case, more than 50% of the risks they were taking were actually unintended bets. They were making bets they thought they were making, sometimes larger, sometimes smaller, but never, I don't think, did that amount to more than 50% of their risk.
Jason.
Yes, question, good.
On the prior 2 pages, and I apologize for jumping in here. I know you wanted to follow a more linear pattern, but you know,
I don't mind.
In Quafa Few tradition, and if you recall, people used to just yell out loud. That was the Herb Blanc tradition, but we try to be more polite and orderly here.
Okay. No, I'm very happy to be interrupted.
So I just wondered if, you know, you positioned it in the context of cap weighted indices, but if we move to a world where, you know, stock selection is really sort of replaced by smart betas, and the expression of portfolios or views is kind of, you consider the world to be of linear equity views to be linear combinations of smart betas, then and all the indices are perhaps factor weighted indices, not necessarily cap weighted, then maybe it's a different.
Can I just check? That is Malind, isn't it, talking?
Yes, yes,
yes. Good. I'm very glad that you've raised that. I'm going to be spending a lot of time talking about managers having stock selection skill. My own personal belief is that it's not stock selection skill at all. It's actually factor selection skill. I've built many multi-factor stock selection models. Some of them have been used by managers, often successfully. I also know that if you look at almost any portfolio using a sensible factor model, again, quote, a reasonably diversified portfolio, unquote, you will find that almost all the risk is factor risk. There will be a small residual amount of stock-specific risk, but it seems plain to me that most of what people are doing when they say they're doing stock selection is actually factor selection. So I basically agree with you, William. Yeah.
Because I mean, actually, interestingly, both folks like Arnott and Jeremy Siegel have been espousing factor indices for a while, and they've done it successfully in commercial terms as well. But you know, the whole notion, I mean, no doubt, having cap weighted indices creates lots of problems, and I guess I was trying to see if that paradox could be resolved if one didn't have cap weighted indices. But anyway, I apologize for interrupting the flow.
No, that's quite a very interesting point. Thank you. Let's just consider what actually portfolio efficiency is. There are many definitions. One version is an efficient portfolio is one in which each unit of portfolio risk is balanced by a unit of expected return. That's a kind of dry technical definition. An equivalent definition, this is not an alternative definition, it's the same thing but expressed a different way, is that in an efficient portfolio, the investor's views on the relative attractiveness of each stock are reflected in the portfolio as accurately as possible. Putting it very simply, there's no point having stock selection skill if you're not going to make the best use of it. All portfolios will have a mixture of deliberate and unintended bets. If you're running a long-only portfolio, which many people are, it's impossible to eliminate all of the unintended influences. There's always going to be some, but they can be minimized. What you want to do is to maximize your exposure to deliberate bets, minimize your exposure to the unintended bets. If you're working to a risk budget, let's say that your client has told you they want no more than a 4% tracking error, and you do an analysis and it turns out that only half your risk, half your tracking error is coming from your deliberate bets. If you can find ways to minimize some of your unintended bets, that also gives you scope to increase your deliberate bets. And if your deliberate bets do have value, in other words, if you do have skill, that will not only minimize the interference that comes from the noise, it will also exaggerate the outperformance that comes from your skill. And that's what we're trying to do. What about efficient portfolios? Efficient portfolios are like unicorns, mermaids, and the Indominus Rex. They don't exist. Does anybody not know what the Indominus Rex is? I'll wait till we get to question time. You have to see the Jurassic World movies to find out what it is. It was a dinosaur that was created artificially. But anyway, it doesn't exist. In real life, all portfolios are inefficient all the time. So asking the question, is my portfolio efficient, is simply not an interesting question because the answer is always no. The interesting questions is how inefficient is each holding, and then how inefficient is the overall portfolio. And I say again, all portfolios in real life are inefficient all the time. When you rebalance a portfolio, you should obviously be trying to make it more efficient than it currently is. You're never going to get to perfect efficiency. It's always going to be more efficient than it was at the moment, or less inefficient, perhaps. So in order to be able to measure this, we need to have a way of determining the inefficiency of each holding and a way to measure the inefficiency of an overall portfolio. If we are going to measure overall portfolio inefficiency, ideally we'd like a measure that can be used to compare the relative inefficiency of different portfolios. And let's see if we can do that. So what I want to do here is to think about the basic process of Markowitz portfolio optimization as an engineering process. I said originally that I thought Markowitz's idea of balancing expected returns against risks was a brilliant idea, and my problem with it was the implementation. So this is the standard implementation. You start with a bunch of expected returns, you go and get some risk numbers from somewhere, buy a risk model, build a risk model, stick them all into an optimizer, crank the handle, and get out an efficient frontier. And on the efficient frontier, you're going to pick a portfolio somehow, and that portfolio will be an efficient portfolio. That's the basic idea of implementing Markowitz's idea of portfolio efficiency. Think about this as an engineer would. You've got various moving parts here. We need to worry about the tolerances involved. So expected returns are, not to be too technical, very fuzzy ranges. Somebody might say they have an expected return of 10% on something. They certainly don't mean 10%. If they're very good or very confident, they might mean somewhere between 5 and 15. If they're a bit less confident, they might mean somewhere between 2 and 18, or maybe 0 and 20. They certainly don't mean 10. So that's expected returns, very fuzzy numbers. Now we go and get some risk numbers. Risks are more stable than returns. You can use historic data, at least in normal market conditions, to get a pretty good estimate of what risks are going to be in the next period. Nonetheless, as I've explained already, there are estimation errors around. So they're a little bit fuzzy. They're not precise. So what we're going to do with the standard method of implementing Markowitz's idea is we're going to take very fuzzy numbers, we're going to mix in some somewhat less fuzzy numbers, and then we're going to solve to 2 decimal places. I put it to you that when you think about it like that, that process makes no sense whatsoever. So now what do? Do we throw out the baby with the bathwater? No, we keep the idea, but we use the process the other way around. We just reverse the process. So what we do is we start with the current holdings. Notice that we know what those are to at least 1 and probably 2 decimal places. So we're starting with very hard data. Now we put some risk numbers in. Now we're introducing some uncertainty. But now with the holdings we have and the risk we've just got, we can work out what the risk structure of the portfolio is. Now we reach for Markowitz's idea of efficiency. And we say, wherever the risk is coming from, if the portfolio was to be efficient, would also be where the returns would be coming from. So we can back out what the returns would have to be to make the current portfolio efficient, okay? Notice that when you run a forward optimization, Markowitz optimization itself is implicitly doing this. The next thing it's going to do is the same thing that we're going to do, which is we're going to compare the implied returns for each stock with the expected returns. The difference is Markowitz is going to compare whatever the implied return is calculated to 16 decimal places with the expected return it was given assumed to be to 16 decimal places. And if it finds those two numbers to be different, it's going to judge the holding to be inefficient. This is the basic reason why Markowitz always wants to trade every holding, if it's allowed to. What we're going to do is we're going to say, hang on a minute, I know we said our expected return was 10. What we actually meant, for the sake of argument, was 5 to 15. So the comparison that we're going to do is not, does the implied return equal 10? The comparison we're going to do is, does the implied return lie inside the range of 5 to 15? Because if it does, given the limitations of our forecasting ability, we're going to deem this holding to be efficient enough. Okay? All right, let me move along. How do you calculate implied returns? Quite simply, happy to send a derivation of this to anybody who's not familiar with it. But basically, the implied return for a stock I, that's the IRI on the left of that main equation, is the expected return on the portfolio. So think of that as the portfolio weighted average, plus an adjustment. And that adjustment has to do with your risk aversion parameter, that's the psi. That's a risk aversion parameter in return standard deviation space, by the way, multiplied by the portfolio risk, which is fixed because we've already fixed the whole, we've already got the holdings, multiplied by this term beta IP minus 1. Now, in a moment, we'll just have a look and see what beta IP is. It's actually the beta of stock I to the whole portfolio P. And what it tells us is whether the holding is more or less risky than average for the whole portfolio. If you think about what the equation is saying, it's saying that the implied return on stock I is the portfolio average plus an adjustment. And that adjustment has to do with whether the holding is more or less risky than average. If it's more risky than average, beta IP will be bigger than 1, and the adjustment will be a positive adjustment. And if beta IP is less than 1, that means the holding is less risky than average, and that means the adjustment was negative. And so intuitively, what this is saying is that wherever the more risky positions are, is where the more return should be coming from, and whichever are the less risky positions, these are positions, not stocks, notice, then we'll expect a lower return. Now, there are, of course, an infinite number of solutions to this problem as you vary psi from 0 to infinity. If you imagine that we have a set of expected returns on some scale, let's say 0 to 20, for example, we can generate lots of different sets of implied returns. Some of them will be on enormous scales, some of them will be on very tight scales. Let's imagine that the portfolio return ends up being 8. So all of the scales will be centered around a value of 8. Some of them will range from a bit below 8 to a bit above 8. Some of them will range from vastly negative to vastly positive. What we would like is to choose a solution that is as close as possible to the expected returns that we started with, so that when we do our comparison, as far as possible, we're comparing like with like. Let's just have a quick look at what beta IP is to get some intuition. Now, can you see my cursor running around on the screen? I think you probably can. So on the top here, we have portfolio risk as variance, that's BP, is given by this double summation. These are the holding sizes, Xi and Xj. And this is the full covariance matrix, which is typically reconstituted from a multi-factor risk model. What I'm interested in doing is identifying how much risk is coming from holding I. And so that will be, see if I can't do that. Okay, do that. No. That will be the sum inside the summation inside these curly brackets. What I actually want to do is to express that as a percentage of the total risk in the portfolio. So I'm going to take the bit inside the curly brackets down here. I'm going to multiply it by 100, and I'm going to divide it by the variance of the portfolio. And that's going to be the percentage contribution of holding I to the total risk of portfolio P. Now I'm going to do some shuffling around to clarify what's going on. The Xi is fixed for holding I, so I can take that outside the summation, and there it is. I can also remind myself what Cij is. Cij is the covariance between the returns on holding I and the returns on each holding J. I shouldn't say each other, it's all of them, all holdings J. Now what I'm going to do is going to collect all of the terms with J in them together. I'm going to take these things here and put them inside there with the RJs. So we end up here with 100 times Xi times the covariance of the returns to stock I with these things. And these things, if you think about it, are simply the return to the portfolio. This is the sum across all holdings of the holding size times the return on the holding. This is the expected return on the holding. That's going to be RP. So this thing collapses down to the covariance between the returns on I and the returns on the portfolio P. Now what I'm going to do is I'm going to take this percentage contribution to risk from holding I, and I'm going to divide it by the percentage holding. So let's just give ourselves an example or two. Suppose I've got two 5% holdings, and suppose one of them is giving me 8% of the risk, and one of them is giving me 4% of the risk. So when I divide the holding size, when I divide the percentage contribution to risk by the holding size, in one case, I'm getting an 8% contribution divided by a 5% holding, I'm going to get a ratio of 1.6. In the second case, where I've got a 3% contribution to risk coming from a 5% holding, I think I said 4% contribution to risk coming from a 5% holding, I'm going to end up with a ratio of 0.8. Those ratios are actually, as you can see from just following this through, cancelling the 100 XIs top and bottom, you end up with the beta of the stock to the portfolio. That's what those things are. And the most useful thing about that, as I said on the previous slide, is that that's what determines the return required for efficiency. Okay, let's move along. I'm not going to show you the derivation of this, but I did say before that what we want to find is the set of implied returns that is as close as possible to the expected returns we started with, so that when we do the comparisons, we're comparing like with like. To solve for that risk aversion parameter, you end up with this expression here. So what I'm calling here min psi, this is the risk aversion parameter that makes the implied returns as close as possible to the expected returns. This is quite an interesting expression, and it's worth having a look at to understand what it's doing. On the bottom, we have the portfolio risk, which is a standard deviation, which is therefore necessarily positive. We also have a sum of squared terms, which is also therefore going to be positive. So the denominator here is always positive. So the sign of this thing, which hopefully is positive if we're rational investors, is going to be determined by this thing on the top here. Now, this thing on the top here is a sum of products, one for each holding. And the product is between the expected return on the stock compared to the portfolio average and the riskiness of the stock compared to the portfolio average. Notice that the beta of the portfolio to itself is going to be 100% of the risk divided by 100% of the holdings. It's going to be 1. So although this says beta IP minus 1, you can think of this as beta IP minus beta PP. But basically, this term here is telling us whether the holding is more or less risky than average, and this holding is telling us whether the stock is more or less attractive than average. Okay, so now imagine that we're a sensible manager and we've made our biggest bets on our most attractive holdings. That means that when I'm doing the summation across all the holdings, if I've got a more attractive stock, I'm going to have a more risky holding. And so both these terms are going to be positive. If, on the other hand, I have a less attractive stock, less attractive than average, I'm also going to take less risk than average. And so both of these terms are going to be negative, and a negative times a negative gives us a positive. So again, it's going to be a positive contribution to the total sum. So if I've managed to do that, make bigger bets on the more attractive stocks and smaller bets on the less attractive stocks, mostly throughout the portfolio, I am going to get a positive numerator, and that's going to give me a positive psi. If, on the other hand, I've been rather silly and I've made small bets on my more attractive stocks and large bets on my less attractive stocks, it is possible to end up with a negative psi here. And that tells us that this manager has built a portfolio being basically irrational, trying to maximize risk at the same time as maximize return. Okay, we've actually seen some portfolios like that. Here's the expression for implied returns again. I just want to rearrange it slightly quickly to make a point. If we just take the expected return over to the left-hand side, what we have here is a measure of whether the stock is, by implication at least, more or less attractive than average. And here we have a measure of whether it's more or less risky than average in the context of the portfolio. If we take this over to the left and divide it, we see that the return risk trade-off is a constant throughout the portfolio. So we're back to the definition of efficiency. Okay, let's move along. All right, so one way of determining how efficient a particular holding is to compare the implied return and the expected return. If the portfolio was perfectly efficient, the implied return would equal the expected return, and these differences would all be zero, okay? If the implied return is bigger than the expected return, that says that the holding is overweight, usually. So selling it would reduce the size of the holding, that would reduce the contribution to portfolio risk, that would reduce the implied return required to compensate for the risk, and we would keep on doing that until the implied return equaled the expected return, and then in pure market risk terms, the holding would become efficient. If, on the other hand, the implied return is lower than the expected return, by implication, usually, the holding is underweight. So we need to buy more of it to improve the efficiency of the portfolio, of the holding, and of the overall portfolio. If we look at the absolute size of the differences between the implied returns and the expected returns, that simply tells us which holdings are more inefficient than other holdings, okay? So now we know how to tell whether each holding is inefficient and how much, and we can tell whether the holding is too large or too small. We'd like to get a measure of portfolio inefficiency. So one way of doing it would be to take all of the individual holding inefficiencies, square them to get rid of the fact that some of these are positive and some of these are negative, add them all up, I should say take an average of them all, and then take a square root again, and that would give us a measure of portfolio inefficiency. Notice that this measure is in units of return, but notice also that it's scaled by the return. So if we was to simply just double all the returns just for fun, it wouldn't change the analysis, but it would mean that this measure here would double as well. So that's not going to do for comparing the inefficiency of one portfolio to another portfolio. So what we can do instead is we can rescale the measure of inefficiency by dividing all of these by the expected return on the portfolio. You can think of that, if you like, as normalizing it, so the portfolio expected return is always 1. And now we have a score, a measure of portfolio inefficiency that we can use to compare different portfolios against each other. Okay, that's the theory. Now I'm going to do a quick experiment. We're doing time, we seem to be okay, so that's good. What I'm going to do is I'm going to give myself a set of expected returns that I know has some skill in it. I'm going to argue that this is a reasonable proxy for a manager who has reasonably good stock selection skill. He doesn't always get it right. He sometimes has bad periods. On average, over long periods of time, he does have some skill. And I'm going to use that to pick some stocks, and I'm going to construct portfolios in various different ways. And my ultimate goal now is to do two things, is to look at the results. I'm going to find the results are different because of the different methods of portfolio construction. But in particular, I want to look at the measure of portfolio inefficiency and see how those vary. And what I also want to do is to look, if I can, at the performance that comes out and see how much of it is deliberate bets and how much of it is unintended bets, and see how that all plays out. I think we'll find the answers quite interesting. So what I'm going to do, and this harks back to Melin's very good point a few minutes ago, I'm going to build a stock selection model by using style factors. Namely, I'm going to use a 50-50 combination of quality and value. Quality I'm defining as return on assets. Was that another question? Pause for a question? No, perhaps not. Okay. Quality is return on assets, return on equity, and cash flow to sales. Value is a composite of book to price, earnings to price, and cash flow to price. So these are being calculated on fundamental data. They're being normalized. They're being averaged. And then I'm going to do a 50-50 combination. And my stock selection rule is very simple. Every time I rebalance, I'm going to rank the S&P 500 stocks high to low by the QV score, the composite score, and I'm going to pick the top 100 stocks. There's a picture. I'm going to do this from the beginning of 2007 up to actually to about September of 2021. So it's almost 15 years. The red line there is the returns to the value factor in our risk model. It did very well, 2007, not quite so much during 2009, then it came back again. Kept on doing very strongly up to about the end of 2014, at which point value kind of stopped working. Had a long period of not doing very much at all. In 2020, it actually did quite badly. If you were long value, you were underperforming nastily. And then round about the beginning of 2021, it started picking up again, and there we go. The turquoise line is quality. Quality during 2007 and 8 also did quite well until we had the crash. There's the crash round about there. During the recovery, it did fairly badly. Then it didn't do very much at all till about the end of 2013. Then it started picking up quite strongly and carried on doing quite well until about the end of 2019, when it had another hiccup. And then round about somewhere in early 2021, it started doing quite well again. The purple dotted line in the middle is the QV composite. That also started off doing quite well. Both the quality and value did quite well during that period. Then we had the crash. There was a bit of a hiccup. Then it didn't do very much for a year or so. And then once the recovery was kind of over, it picked up steam again and chugged along quite nicely. There were a few hiccups. There's one there around about the end of 2013. There's one here around about the end of 2010. There's another one here at the end of 2015. A little bit of bumpiness here in 2017. But on average, it's chugging along quite nicely up till about the middle of 2019. Then it doesn't do so well for a while. And then again, it started picking up again from about the beginning of 2021.
Jason, an important slide. Your factory returns are long only. I think you said top 50 or something.
No, I did not say that. These are factory returns that comes out from cross-sectional regressions, regressing the beta to value and the beta to quality, and indeed the beta to 3 or 4 other things at the same time against the returns over the subsequent period, estimating the returns period by period, and then chain linking them together. So arguably, these are not returns you would actually achieve in practice, but if you load it up on the composite, you will get something that reflects the fact that these things go up over time. We actually, a quick digression, we actually have to build hybrid risk models. What I mean by that is that some of the factors are time series factors, but style factors have to be cross-sectional. You cannot estimate stock betas to style factors by running time series regressions because the betas fail the test required to do time series regressions, which is namely, you can only do a time series regression to estimate a beta if you can reasonably assume that the beta itself is stable over time. Style factor betas, of course, are interesting precisely because they are not stable over time. I buy cheap stocks because I have a very strong belief that they're not going to stay cheap. If I thought they were going to stay cheap, I wouldn't be the least bit interested in them and I wouldn't buy them. But I buy them because I don't think they are going to stay cheap. I think they're going to go back to fair value. And if I'm lucky, they're going to overshoot even. And in the process, I'm going to make some money. So you cannot build style factors in a risk model by doing time series regressions, no matter what Professors Farmer and French will tell you. You have to use cross-sectional regressions. That's how these are estimated. If you want me to be, let me just see if I can remember. These are estimated jointly with 3 other style factors, which are momentum, liquidity, and dividend yield, of course. Yes, dividend yield. Okay. But that's what these are.
Okay, so these are joint Farmer French type of, but cross-sectional regressions. They're not the tercile kind of portfolios that.
No, they're not. No, these are not portfolios. What I'm showing you here is not portfolios. These are just chain linked, period by period estimated style factor returns, chain linked together.
Okay. Okay.
which notices how most people build stock selection models.
Right. Right.
So imagine I build a stock selection model using value and quality. This is how the model behaves, and I'm going to now use this to. I'm going to use this composite score to pick my stocks. Okay. All right. As I said, I want to argue that this is a reasonable proxy for a manager who has basically good stock selection skill, but who also has occasional off periods, which I think is realistic. We're going to start these. Each of these strategies are going to start with $100 million in January 2007. They're all going to be rebalanced every 12 weeks. You can think of that as quarterly if you like. We don't like rebalancing on calendar quarters because you get crowded trades there and it mucks things up. So we do it every 12 weeks. We're also going to be assuming round trip transaction costs of 30 basis points, which is possibly a bit generous. And we're going to assume an annual management fee payable quarterly of 20 basis points per year. So all the results I'm going to show you have had those transaction costs and management fees deducted at the appropriate times, either on the rebalance or at the quarter end for the management fee. So we're going to test 7 different strategies. We're going to test equal weighting, capitalization weighting, attribute weighting. If you're not familiar with attribute weighting, that's where the holding size of the stock is a proportion, direct proportion to the stock selection score, the QV score in this case. So if one stock has a score that is twice as big as another stock's score, it gets twice the weight. Okay. S&P create a bunch of what they call pure style ETFs where they do that. Okay, so that's what we're doing, attribute weighting. We're going to use inverse volatility weighting. We're also going to do a risk parity weighting version. And then we're also going to use 2 sorts of optimization. We're going to use Markowitz optimization, which is, as I described before, and what I'm going to call smart portfolio optimization, which is the going back the other way. The resulting performance will vary considerably. I'm going to show you that. They all use the same stocks. They all use the same rebalancing frequency, same transaction cost, same management fee, same everything, except the method of portfolio construction. And you're going to see that the results do vary. Now, the first 5 of these, that's equal weighting, cap weighting, attribute weighting, inverse volatility, and risk parity. These are all methods of construction that give you one answer. They just tell you if you're equal weighting, hey, guess what? You've got 100 stocks, put 1% in each, and you're done. That's it. There's no other choices. That's it. If we're going optimization, of course, we're going to get a frontier. And if we get a frontier, we have quite a lot of choices. We can be different points on the frontier. So what I'm going to do is I'm going to actually run it doing 3 different versions of optimization. And I'm going to choose points every time I rebalance. I'm going to generate a frontier. And I'm going to pick points that are either 30%, 50%, or 70% up the frontier in terms of increasing expected return. Okay. I also want to show the effect of putting constraints on optimization. So I'm going to do another 3 versions of Markowitz optimization. The first set are all unconstrained. The second set, I should say they're unconstrained, except they're all long only, of course. The second set have 2 additional constraints. One is there is a constraint that the most that I can buy of a stock the first time I buy it is 5%. So that's a maximum initial holding constraint of 5%. To be quite clear, once I've bought it, if it goes above 5%, I do not have to trim it. I'm allowed to carry on holding it. If it gets to 6, 7, 8%, as long as the optimizer doesn't want to sell it, we're okay to hold it. But the constraint is the maximum initial holding is 5%. The other constraint I'm going to put on is a beta to benchmark constraint. This is something that lots of managers do. I can guess as to what the reasons might be. But what we're going to say is we want a beta to benchmark to be somewhere between 0.95 and 105. In other words, fairly close to 1. We want to have the same kind of market exposure as the benchmark itself. Smart portfolio optimization. Let me explain a little bit about this. I'm just listing some of the issues that arise if we do Markowitz optimization. This is to some extent, I'm repeating myself, so I'll go quickly. It's assuming that we know the returns and risk precisely when actually we don't. It thinks all portfolios are either efficient or inefficient. This is a binary distinction, and it's quite absolutist. You're either efficient or you're not, and there's nothing else to say about it. We think that's silly. We think that all portfolios are inefficient all the time, but we also think that some portfolios are more efficient than others. And that's what we're trying to do, is to build more efficient portfolios. Markowitz optimization typically generates very high turnover, and very high turnover is generally regarded as a bad thing. It often wants to trade every holding unless it's constrained from doing so. I've explained why that is. It assumes that all the forecasts that you make are equally valid. That's not an assumption that is pointed out very often, I don't think. I would observe that it's incompatible with conviction weighting, which a lot of managers like to do. You can make forecasts for 100 different stocks. They may all be expressed as individual numbers. You yourself will know that they represent different ranges, and it's entirely possible that you'll be more confident about some of your forecasts than you are about others. You may have two forecasts of 10%. One of them might be a 5 to 15, 10%. The other might be a 0 to 20, 10%. Clearly, you are going to favor the one that's 5 to 15 because you're more certain about it. Another problem with Markowitz is that it thinks all returns are equally good, so maximize all returns, and all risks are equally bad, so minimize all risks. And I would argue that that's not actually right. You don't want to minimize all risks. You want to minimize the unintended bets. You don't necessarily want to, in a sense, you want to maximize the deliberate bets. One of the other strange things about Markowitz optimization is that it ignores the current portfolio until it's finished building an efficient frontier, and then it only looks to see what's in the current portfolio in order to calculate the required trades to get to where it wants you to go from where you are at the moment. We think the current portfolio contains quite a lot of useful information. And then the last thing about most standard implementations of Markowitz is you don't actually get an efficient frontier. Sometimes you get just given an optimal portfolio, which has been arrived at because someone has made some assumptions about your risk aversion. Okay, so what we do in smart optimization is we acknowledge that expected returns and risks have varying degrees of confidence. We also understand that some of the current holdings may already be efficient enough, and there's therefore no point trading them, given the limits of our forecasting ability. I'll start showing you some results in a minute. The main point of these backtests is to see how well the stock selection skill was reflected in the performance of each strategy, as shown by the percentage of each portfolio's performance that came from the deliberate bets. Now, clearly we're making a deliberate bet on this QV composite stock selection model thing, but we're also saying that we're long only fund. And so we're therefore necessarily taking a bet on the market. I would argue that that constitutes therefore a deliberate bet. In the risk model that we're using for this is a US risk model. We actually have two market factors. One is called US large market factor, and one is called US small market factor. The US large market factor is the top 500 stocks by capitalization. When we update the model, capitalization weighted. That will probably remind you of the S&P 500, which is deliberate. The US small market factor is you take the 2,000 stocks from stock 1001 down to stock 3,000 and capitalization weight them, and that will probably remind you of the Russell 2000 index, and that is also deliberate. We are deliberately mimicking the standard large cap and small cap benchmarks. Since I'm only choosing stocks from the S&P 500, and that is my benchmark, I'm going to say that my bet on the US large market factor is therefore a deliberate bet. If it turns out I have a bet on the small market factor, which I may do, that will count as an unintended bet. Notice that over this 15-year period, the US stock market did have some ups and downs, but on average it rose quite strongly. So many managers impose beta the benchmark constraints. I'm going to show you some tables of numbers. I've color-coded them so that blue means good, red means bad. If we're looking at returns, then high numbers will be blue and low numbers will be red. If we're looking at risks, then high numbers will be blue and low numbers, low numbers will be blue and high numbers will be red. Hopefully it won't be too confusing. All right, on the left, we have our 5 heuristic methods. We have 3 unconstrained Markowitz optimizations, 3 constrained Markowitz optimizations, and 3 smart portfolio optimizations, 1 of which is unconstrained and 2 of which are constrained. I should have explained about that. In that bottom section, smart portfolio optimization 1 is an unconstrained smart optimization. 1C is where I put on the constraint that the initial holding can't be more than 5%. And then the third one, CB, is where I've also put on the beta to benchmark constraint. Down the bottom is the S&P 500 itself. These are averages over time in the average number of holdings column. In the heuristics section, it says 101. That's because I'm holding 100 stocks and I also have a cash holding. After I've rebalanced, the cash holding will be 0. In the 12 weeks between rebalances, the cash holding will be accruing dividends and such like other things that may happen, takeovers and whatnot. So there's going to be 101 holdings. Okay, so this is return, risk, and turnover, annualized numbers. The turnovers, we look at the heuristics first. You can see attribute weighted 160, cap weighted 134, and so on. All of those are around about the 150% a year mark. If we look at the 3 unconstrained Markowitzes, they're all north of 200, average of about 230. If we put some constraints on, the turnover drops a little bit, down to about 180%, but it's still higher than the heuristics. If we look at the smart optimizations, the unconstrained one is 140%. So that's lower than all the others, but still high-ish. And if we look at the constrained ones, they're down about just over 100%. So they have the lowest turnover. You will notice that in this column, blue is good, red is bad. So the low numbers are blue, the red numbers with the Markowitz unconstrained optimization are bad. Annualized returns, perhaps unsurprisingly, attribute weighted gets the highest return. We know that the QV score generates decent returns on average over the 15-year period. So unsurprisingly, that gets the highest return of the heuristic methods. The rest of them are all about 11 and a bit %, not a lot to choose between them. Unconstrained Markowitz optimization is giving low returns. Why is that? That's because it is unconstrained, and amongst other things, we're not constraining it to have any particular beta to the benchmark. And so you will see in a moment that those things all have pretty low betas to benchmark. So they're missing out on the market return. The constrained Markowitz optimizations do a better job. Some of them are actually beating the heuristic returns. We've got a 13 there. The 12.3 is almost the same as the attribute weighted. Of course, they have got very high turnover. Those are after transaction costs, by the way, so that's allowing for the high turnover. And then in the smart optimizations, again, the unconstrained one, which has the highest turnover, 140, ends up with a net return of 11.7. So that's kind of up there with the heuristics. But the other two, which are constrained, are actually the best two of the whole lot. The S&P itself over the period had a return of just under 10% average. So these things have all beaten the S&P 500 over the whole period. Next column is the risk. So there's all about sort of 16, 17% for the heuristics. A bit lower for Markowitz until we get up to the 70% point on the frontier, when the risk goes up to 18%, of course. You can see from the second section of Markowitz's, which are constrained, we must have a very small frontier or a very steep frontier, at least because the risk doesn't change very much, goes from 15.5 to 15.9. Smart optimization, we managed to get down to 14 and something in some cases, but even the best performing one only has a risk of about 16. All right, let's see a picture. This is return against risk, total return against risk, annualized over the period. If you can see my cursor, here's the S&P down here. Pretty much everything beats it except the lowest Markowitz, unconstrained Markowitz. That's at the 30% point up the frontier. The heuristic methods, there's cap weight, risk parity, inverse volatility, attribute weighted, very high return, but also very high risk. And equal weighted, clearly that's got a small cap bias. That's also very high risk. The unconstrained Markovitzes are all quite low returns. So there's 30% up, 50% up, 70% up. So we've now got a frontier that is very long and flat. The constrained Markovitzes are up here. So now we have a frontier that is very steep and not very wide. So they're doing quite a good job. And here are the smart optimizations. This is unconstrained. This is with a maximum holding constraint of 5%. And there is a maximum holding constraint and a beta to benchmark constraint of close to 1. I particularly draw your attention to the fact that going from here to here, what we've done is constrain the beta to benchmark to be close to 1. And whilst it's true that that's added some return, it has also added a lot of risk. I'm going to come back to that point in a moment. Comments, I think I've done most of these comments, so I'm going to skip past that. You can read them again later. This is relative performance, and what I'm showing you now is also what the beta to the S&P 500 actually was. It was unconstrained for the heuristics, so these are just accidents. They've all ended up being fairly close to 1, ranging from 0.94 for cap weighted to 1.1 for equal weighted. That's probably not a surprise. Unconstrained Markowitz, as I said, we actually have quite low betas, which explains the low total return. Constrained optimization, these we've constrained the betas to be between 0.95 and 105. Unsurprisingly, they're all between 0.95 and 1. And again, these first two are unconstrained, so they're sort of similar to the Markowitz unconstrained. This one has been constrained again between 0.95 and 105, ends up being pretty close to 1. So those are the betas to benchmark. What about the alphas and the returns? I'm going to focus on the relative return after costs, all right? So attribute weighted, we know did the best return, therefore has the best outperformance. After costs, and almost but not quite, because it has quite a high risk, has the highest alpha. This Markowitz is the one that actually underperformed the S&P 500. So that's got a minus 30 basis point underperformance. 50% more or less tracked the S&P, and the 70% one squeaked out 90 basis points above. There we go. The best performers were 70% up the frontier with quite a high risk, and the two constrained smart optimizations. There's the tracking errors. These were not constrained at all. There's no constraint on tracking error here. All of these are around about 4%. These are extremely high, so kind of 10%, back down to about 3 and a bit%, and these are back high again. Okay. This chart, be a little bit careful. It looks like the other one. What this is the relative return against the beta. Okay. So I meant to put the S&P 500 on. The S&P 500 would be at this intersection here. It's got a beta of 1 and the relative return against itself, of course, of 0. So there's the 30% unconstrained market underperforming. This is actually quite a similar chart to the other one, so I don't think I'm going to spend any more time on it. There are some comments there if you like. This is the last one. Almost done. What I'm doing here is I'm separating out the deliberate bets from the unintended bets. The deliberate bets, I'm going to argue, are the returns to the US market large factor, the US large market factor, and the returns to the quality and value factors, okay? I've run a performance attribution on these funds over the 15 years, looking at returns every 4 weeks. We use 4-week returns to build our risk model, not calendar months, but it's almost the same thing. And these are the averages over the whole period. So these two, this is the deliberate return, deliberate bet on being invested in the market because I'm long only. This is the deliberate bet on building portfolios that from stocks that have high QV composite scores. If I add these together, I get the total deliberate bet. If I subtract that from the total return that the portfolio actually got, I get the contribution from the unintended bets. This is actually slightly unusual, but in this particular case, all of these, it turns out, are negative, okay? Sometimes that happens, sometimes these can be positive. You could be lucky sometimes. But in this particular case, the unintended bets did what they often do, which is to damp down the return that was coming from the deliberate bets. There are the total returns on the right-hand side over there. So I hope you can understand that. If we just have a look at this, in the QV return column, again, unsurprisingly, attribute return gets the highest contribution from the way it's from the exposure it has to the QV factors. That, of course, is because the way in which the portfolio is built in proportion to the QV betas. These are all about 4%. Markowitz manages to push these up to 6, 8, or 10%. Even with constraints, it manages to get above 5 to almost 7%. And here again, we're also around about sort of 6% on average. So it turns out that the optimizations are generally doing a better job of capturing the deliberate bet on the QV composite stock selection model than the heuristics are. What about the long-only bet, the market large bet? Unconstrained market bets, as we've already explained, doesn't do a very good job of capturing that. If we put a constraint on the beta to benchmark, it does a much better job. These are all very, very close together. You saw the betas themselves were also very, very close together on average over the period. So these are not dissimilar from these things, which ended up having betas of close to 1 by accident. I would stress that. Unconstrained optimization, smart optimization. If we don't constrain the beta to benchmark, we do a poor job of capturing that. If we do constrain it, we do about the same as the market is, but then end up with 16.9% deliberate bets from this thing and this thing together. Okay, here's a chart. Now, what I've done here is I've tried to plot the returns from deliberate bets and the returns from the unintended bets. All of these green bars are the returns coming from the bet on the market itself. I'm going to say that is coming from being long only. Here is the S&P itself. It has a return from its exposure to the long only market factor of about 10%. And you can see that in this case where it's constrained and these 3 cases where the beta is constrained, the green bars are very similar as they are for the S&P 500 itself. In the unconstrained optimization cases, that's these 2 smart optimizations and these 3 Markowitz unconstrained optimizations, the green bars are much shorter. And that's because the beta ends up being much lower. In the case of the 5 heuristics, the exception of risk parity, which is a slightly low beta, they're all pretty close to being the same as S&P 500 itself. The blue bars on top are the contributions to return from the QB composite. So these are all about the same, with attribute weighting being slightly the highest. They're all about 4%, I believe. Markowitz unconstrained does a better job of capturing QV, but a worse job of capturing the market return. So those kind of wash out. Constrained Markowitz optimization also does a somewhat better job of capturing the QV composite than the heuristics do. And they have the advantage of having a beta of close to 1, so they capture the market return as well. Smart optimization does a pretty good job of capturing the QV. And in the case of the one where we constrain the beta to benchmark to be close to 1, it gets the highest return. But look also at the unintended bets. These things are all around about sort of 3%, 2.5%, 3%. Markowitz unconstrained, it's about 4%, about 6%, and about 8%. So that's undoing a lot of the good that was done up here, capturing more of the QV composite return. If we constrain the optimizations with the initial holding and the beta to benchmark, we get pretty decent returns, deliberate returns, but we also have fairly chunky unintended bets, all around about 4%, minus 4%, pulling those returns back. The smart optimizations, this is one very interesting thing I want you to see. The 2 smart optimizations do a very good job of minimizing the unintended bets. Those are much, much smaller than any of the other methodologies, okay? These things had not such great returns, They did a very good job of capturing the QV composite, but because we hadn't constrained the beta to benchmark in a period when the market did quite well, we missed out on capturing the market return. But nonetheless, you can see that almost all the returns we did get came from deliberate bets, offset only by very small unintended bets. Here is perhaps one of the most interesting things in the whole presentation. The difference between this one and this one is that we imposed a beta to benchmark constraint. And in so doing, we increased the height of the green bar from about, what is that, about maybe 7.5 to about 10%. So we added maybe 3 percentage points to the deliberate return by putting that constraint on. Unfortunately, we also decreased the hit from the unintended bets by almost the same amount. And so the net effect on the total return of the portfolio was actually very close to zero. I think I've got the actual numbers down here, yes. Okay, that's this one down here. By constraining the beta benchmark, we increased the positive contribution to the market factor by 2.68%. Unfortunately, the unintended bets decreased, I should have said decreased, by 2.59% at the same time. So we're putting on a constraint where we are stopping the optimizer from maximizing deliberate bets and minimizing unintended bets. And so the net increase was only 30 basis points. And so I conclude by asking, was it really worth the trouble of putting on the constraint and taking on the extra portfolio risk? This is the last slide. We're almost finished. You'll be glad to know. This is our measures of portfolio inefficiency. Here are the heuristics. I draw your attention to the fact that the capitalization weighted portfolio appears to be the most inefficient. Attribute weighted, not so bad as the other heuristics, but worse than all of the optimization methods, okay? This is the S&P 500 itself, but it doesn't really count because this wasn't built deliberately to capture the QV composite. So, but it's there for comparison nonetheless. Unconstrained Markowitz optimization does quite a good job of creating efficient portfolios, but as we already saw, the returns are nothing to get excited about, and the risks can be actually quite high. This is where we have a fairly wide but quite flat efficient frontier most of the time. These are the constrained Markowitz optimizations. They are not as inefficient as the heuristics. 30% is almost there. As we go further up the frontier, we're able to take more account of the QV composite, thereby decreasing the inefficiency to some extent. The totally unconstrained smart optimization is fairly inefficient, at least in comparison to the Markowitzes. That's because it has a relatively small number of holdings. It's about 16 holdings on average, and therefore has limited scope for diversifying unwanted risks. The constrained optimizations come out pretty well in terms of general portfolio inefficiency. And lastly, this is the S&P 500. This is not entirely fair. This is measuring its inefficiency, only thinking about the extent to which it managed to reflect the QV composite return forecast. And since it wasn't built to do that, it's not surprising that it's not doing a great job. Okay, I think I've said most of those things, so I'm going to skip past that. And we've come to the end. So, let me quick summarize and then I can stop. I think Markowitz's idea of trading off expected returns against risks is a wonderful idea and very valuable, and it's certainly what all active managers ought to be doing. It needs to be interpreted in terms of relative efficiency, not absolute efficiency. It is simply not useful to think in terms of some portfolios being completely efficient and everything else being totally inefficient. That's not helpful. Think in terms of all portfolios being inefficient to some extent and some portfolios being more efficient or less inefficient than others. When you're rebalancing a portfolio, what you should be trying to do is to identify the most inefficient holdings in your portfolio and trade those. What you should not bother doing is trading things which, given the limits of your forecasting ability, are already efficient enough. Just let me make that completely clear. Suppose we got a stock, we said the return was 10, okay? Suppose what we meant was somewhere between 5 and 15. We run the analysis on our existing portfolio, and it turns out we're implying a return of 8.2. Markowitz would say, we need to trade this stock. We need to buy some more of it. We would say, actually, although we said 10, what we meant was 5 to 15, and 8.2 is doing a perfectly good job of reflecting our view of 5 to 15, so we're not going to trade this holding. It's already efficient enough. Okay, I'm done. Thank you very much for your time and attention. I hope I didn't put you all to sleep. Unfortunately, I can't see you, so I don't know. Let me stop sharing my screen and then I can wake you all up, perhaps. There's Melinda. Oh, we've still got some left.
That's fantastic. Very interesting. Given that there's a lot of detail there, maybe we can just jump in for some clarifications. So
Sure.
What exactly you meant. Simple bit of intuition. What does it mean for the index itself to have unintended bets when you showed the red bar in S&P?
I was unfairly judging it as if it was a deliberately constructed portfolio trying to capture QV composite. Clearly, since it wasn't, then it's a slightly meaningless statistic. But I just thought I'd put it in for comparison.
So the assumption was that it was, but you would.
So let me give you a slightly different version. It is inefficiently reflecting the idea that you want to have high QV stocks and you don't want to have low QV stocks. Since it wasn't built with QV being taken into consideration at all, unsurprisingly, it's not doing a very good job.
Right.
But it's an unfair test.
Yeah. Well, but it was pari passu against the bars chart, so it makes sense in that context. That's fair. If you could just remind us once again, I mean, so the difference between 1C, I guess, just had a constraint on the initial position size being max 5%, but then one.
So in the smart optimizations, 1 is totally unconstrained. 1C is a maximum initial holding constraint of 5%. Yeah. But once you've bought 5%, if it goes up to 6 or 7, that's okay, unless the optimizer wants to sell it. And then 1CB is initial holding constraint of 5% and a beta to benchmark between 0.95 and 105.
Got it. Okay. And as you pointed out, with the Markowitz 30, 50, 70, you can have pretty, I mean, the market capture is low because the beta often comes out being more than the market.
In the unconstrained Markowitz, there is no deliberate capture of market exposure, which is perhaps unfair if I'm then going to treat market exposure as a deliberate bet. Market return as a deliberate bet. It's slightly unfair. So.
Yeah. So with the other cases, what's the intuition for unintended bets? Just so we go back now and better understand your comment about the unintended bets for managers, or at least for these sample portfolios.
Yeah, what I'm trying to show in the last bar chart with the red bars below and the green and blue bars above is that in this from my point of view, this is a particularly fortunate version because sometimes the unintended bets can still make positive contributions to the total return. But in this particular case, they were all negative. What I was mostly trying to point out, I guess, was first of all that the heuristics have unintended bets, which should not be surprising. Even Markowitz optimization has unintended bets. In smart optimization, the unintended bets are actually quite small. I think they're of the order of about -1% annualized over the 15-year period. And that's because we are deliberately trying to maximize exposure to deliberate bets and to minimize exposure to unintended bets. So I guess I'm trying to demonstrate empirically that it does appear to work, at least in this particular case.
Right. But I guess in your model, unintended is basically the residual with respect to the large cap factor and QB, right? So anything that
correct. Yes. Yeah. So any small cap beta would count as an unintended bet. Any sector bets would count as unintended. Any foreign currency exposures would count as unintended.
Got it. Okay. Excellent. Well, let other people jump in here. I could go on with some other clarifications, but why don't other people jump in here with the discussion?
Victor?
Yes.
Ask me a question. You normally do.
No. Okay. I want to get the presentation. I want to show it to somebody.
Victor, you got some tough questions. You ask me a lot of tough questions when I'm on stage.
No, I would never challenge Jason.
Victor is famous for asking tough questions. By the way, if you want the slides, you're welcome to have them. I'll send them to Melinda. And Melinda, do you have a way of letting people get access to them?
Yeah, we just post them on the website. So
that's fine.
FYI,
I did them already, didn't I? I sent them to you already, didn't I? Yeah.
Okay, well, thank you. And, you know, one of my colleagues here, Krishna, or somebody's gonna post it, or actually Gautam's the webmaster, so he'll post it on the website. Isaac, who I don't see, usually also does the video. So if you want the video online, he's got a YouTube channel. I mean, since we're not, you know, we're not exactly social media influencers, we don't make any effort to promote it, but we do actually have a YouTube channel, which I bet nobody's ever seen.
Be sure to go and look at it.
Even I haven't seen it, so we probably have the fewest eyeball counts ever. But in any case, we'll be happy to post it and maybe even put the link on LinkedIn or something if you like. That's up to you.
That's fine. Yeah, that's fine.
So yeah, very interesting paper results.
I think on the final slide, which I didn't show you, but which would be on the one that Melinda's going to put on the website, is my email address and my phone number. If anybody wants to have any other questions, they're welcome to email me or call me afterwards.
Yeah.
Good.
So, but one thing was, you know, I'm used to thinking of these factor returns in terms of the long minus short, kind of the best versus worst stocks, or top bottom kind of market neutral spreads, right?
Yeah, you understand that has the advantage of being replicable. It has the disadvantage of not being pure.
Right. So these are meant to be pure factor bets.
Those are representations of pure factor bets. Yes, as I say, they're just cross-sectional regressions.
Okay, but they're not investable.
They're not investable portfolios. No, they're conditioned on each other, or they're conditioned on the set of 5 styles that I mentioned earlier.
Right, because you've got some other factors hiding in the background.
Yes, momentum, yield, dividend yield, and liquidity.
Okay. Interesting.
Having said that, I will also add that if you do univariate regressions on value and quality defined the same way, you do actually get recognizably similar results. So that although they are conditioned, they're not much affected by the conditioning.
Yeah.
And besides which, everybody knows that value worked well from 2007 up to about 2013, and then didn't.
Yeah. Well, but I mean, these also, I mean, your recent returns look a bit different than what I'm used to seeing, and I'm wondering if that's because I'm used to seeing the market neutral spreads.
Possibly we have a better definition of value than you do.
Yeah. Interesting. One other question. So you mentioned that, you know, well, actually along these lines, one of the things I'm sure you've noticed is in recent years, a lot of hedge funds have become obsessed with the notion of idiosyncratic returns. And so they actually, and this kind of goes back to the philosophical issue of, you know, if you believe that most manager returns are just some combination of style exposures, right? Like maybe it's just time varying style betas. And there's nothing wrong with that, in my opinion. I mean, there's nothing, if somebody can generate market beating outperformance by having time varying exposure to value, growth, momentum, et cetera, power to them. But a lot of the hedge funds have now decided that they want idiosyncratic alpha from their managers, and they'll basically strip out the part that can be explained by a risk model. So of course that depends also on their risk model.
I think that is largely an illusion. Let me see if I can go somewhere to persuading you. If you if you start with a capital asset pricing model, start with just a simple market model, right? Everything goes up and down with the market to some extent, right? So now I regress all my stock returns on my market returns, and guess what? I've explained maybe 20, 25% of the variance of the average stock. And then I say, well, all right, what about sectors? Maybe I should put some sectors in as well. Or maybe I should put some styles in, or maybe I should put some foreign currencies in. If you keep adding factors into your model, you will find that you're explaining more and more of what's going on of the average stock, right? And as you explain more and more of what's going on of the average stock, the idiosyncratic or residual bit becomes smaller and smaller. Now, when we build our models, we start off by choosing some factors we want to put in them. We do put about half a dozen foreign currencies in because we think that many American stocks have significant exposures to foreign currencies. We have the two market factors that I mentioned. We have the usual, 21 industry factors. We have 5 style factors, okay? And between them, those explain quite a lot of the average stock's variance. But we don't like to then make the assumption that we are so smart and good looking that we've managed to think of all the factors that are important. And we allow for the possibility that there might still be some systematic common factor effects that we haven't yet picked up. So what we do then is we take all the residual returns and we turn them into a residual covariance matrix, and then we build a little statistical factor model to soak up anything else that's left that might be significant. And the practical result of that is that I think we have about 4 statistical factors stuck on the back end of our defined factors. We've got about, 6, 7, 8, 13, 44. We've got about 44 defined factors altogether and about 4 statistical factors stuck on the back end. So there's about 48 factors in our risk model. By the time we've added in those last few statistical factors, we have the comfort of knowing that we've captured everything that is systematic because of the way in which we pick these statistical factors. We've also got the average R squared of the model up around 60, 65%. So we've explained pretty much, certainly a majority of what's going on in most stocks. And for the larger stocks, the constituents of the S&P 500, it's typically quite a lot higher than that. So the idea that there's very much idiosyncratic return left over to capture seems a little bit optimistic to me. Clearly, there are going to be things, if Elon Musk was to get run over by one of his electric cars tomorrow, I don't doubt there would be a significant idiosyncratic return to Tesla stock. Which way it would be, I don't like to speculate. So clearly there are idiosyncratic returns, but the idea that a manager can systematically harvest them consistently seems amazingly optimistic to me. I am a great believer in active management. I believe it's entirely possible to generate reasonably consistent outperformance, but I also think that almost all of that outperformance is factor returns, and that very little of it is actually idiosyncratic returns, or what I would regard as pure alpha.
Right. I would totally agree with you, and that's actually often the case by construction for many quant multi-factor model type of approach. You're starting with a multi-factor construct, so one shouldn't be too shocked if you end up with a lot of common factor risk. That's what they're betting on. But I think maybe fundamental PMs are under a greater illusion that they have.
I'm sure they are.
So that's it's interesting that the hedge fund industry is evolving in this direction where that particular illusion.
Yeah.
In any case, I was also curious. You talked
the other
about
thing, if I may, just to add to what you said before. Of course, there are. I'm never quite sure what the politically correct terminology here is. There are all sorts of risk factors. Some of them are associated with positive risk premiums, and some of them are not. And so you talked about hedge funds stripping out, smart beta returns. If they do that, and if what they're looking at is the usual sorts of portfolios, they're forgetting to strip out the returns that might come from, let's just say, sector tilts or currency tilts, or even a market beta tilt. All of those will contribute to the actual return over a specific period, in addition to whatever they're getting from their styles.
Right. Oh, absolutely. Well, and some of the larger platform shops kind of try to control for that by forcing the PM to be very sector industry neutral to start with. So they kind of insist on those parameters so that they can then lever up the behind the scenes. That's becoming more and more common practice. But in any case, one thing, you hinted at a lot of the issues with Markowitz optimization and maybe some of the literature that we've seen over time in terms of, well, yes, these are the mu and sigmas are all fuzzy estimates with confidence intervals, and maybe one has to resample the frontier, do something else, but it's an estimate. So
I'm going to tell Dick you said that, he'll sue you.
But I'm curious if, what do you think about it? I mean, as you mentioned, one could also just constrain it, right? Like if you have enough smart sort of intelligent constraints, intuitive sort of heuristics on what the right constraints are, you kind of box it into the right corner. But one could just do that with linear, because a lot of the issues that arise really have to do with the issues, with the instability of the covariance matrix. Or, I mean, why not just use linear up, linear program?
I guess you could. We developed this method and it appears to work. So I'm not saying there aren't other methods that work. I mean, you mentioned resampling. I assume that was a reference to Dick Michaud's technique. That also seems to work, as far as I can tell. The disadvantage is that it only works if you've got a relatively small number of assets. In other words, it works quite well for asset allocation, but doesn't really work for stock portfolios because it takes too long to run the optimization.
Right. Yep, that makes sense.
Our approach works for both.
Right.
If I may add, Jason, not the critique, but maybe a comment and support what you're trying to do.
Thank you.
If you remember Matthew Rothman, about 10, 12 years ago.
I know Matthew, yeah.
He performed an interesting research. He took samples, he went to big hedge funds. I think it was like 2006, 7, and 8, good periods for the quant investing. And he asked them for the holdings. He asked them for the alphas, sort of over the years past. He stuffed this into Axioma Optimizer. He had access. He was, at that time, I think, Gleeman. Yeah. And they gave him access to Axioma. Basically, what he showed was that on the level of alphas, and he really went to like a dozen biggest quant equity hedge funds. On the level of alphas, the correlation between the alphas was like 50%, not actually too much.
Right.
And then he went tier by tier. If you optimize against the benchmark without any other constraints, the correlation across holdings was like, again, I'm citing by memory, like 70, 80%.
Yeah.
If you impose relax reasonable constraints like sector neutrality, beta neutrality, neutrality, it was like 90 plus.
Yeah.
So I think that was an impetus why a lot of quantitative places went into trying to build their own risk models, because the thinking is if we all use optimizers and use comparable risk models, there is this crowd effect of
absolutely that's
for the same stuff. So maybe that reverse engineering of yours might sort of spring.
Goldman Sachs many years ago noticed that by that time Barra had probably over 100 clients, And the borrower risk model updates would come out about 4 or 5 days after the end of the month, calendar month. And they noticed that there was a lot of very high volume of trading very shortly after the borrower risk model updates had come out. And being Goldman Sachs, they said, aha, if we replicate the model and we can get an update before the clients get it, we can position ourselves to take advantage. And they did. They did. They built a replica model.
I know.
And that's the model.
Prop trading company, prop trading desk, and later hedge fund, which successfully employed it.
Yeah, that's the model. That's the code they sold to Axioma. So the Axioma model, risk models are based on code that was intended originally to replicate the Barra model.
Yeah.
So it's about 9 o'clock, and I'm told my dinner's ready. Are we done?
Yeah, absolutely. Thank you so much, Jason. That was a great presentation, and we try to keep it informal. So I told you, you'd have plenty of time. There's no cutoff. You can, if you want to talk all night. I mean, there might be somebody, but it looks like
I'd better not. Another time, perhaps.
In any case,
thank you for listening, everybody. Hope you found something interesting.
Yeah,
Cheers.
thank you. That was great.
Absolutely. Thanks everyone for coming. Please don't forget, we got a live event 19th of April. Tony Berkman at Hassel Greens on I think it's West 52nd somewhere. I don't quite remember. I hope to see many of you there. So please.
All right. Thank you. Thank you.
Thank you, Jason. Thank you.
Thank you.
Bye.
Thank you, Professor.
Yeah, thanks for coming, guys. Hope to see you next time.